Have you ever caught yourself thinking, where do I start investing, or can I grow financially without winning the lottery? If so, you're not alone. The truth is, most people don't know how to choose the best investments for each stage of life, and that might be stopping you from building the wealth you deserve. But what if I told you there's a right strategy for every financial level? Whether you're a beginner with little money or someone who already has some wealth and wants to multiply it, this video will show you exactly where to invest, how to diversify your assets, and what steps to take to accelerate your financial growth. And the best part? No fluff, no complications, just a practical, straight-to-the-point guide for you to apply today. I'm going to reveal how big investors structure their portfolios at different wealth levels and how you can do the same, no matter how much you have right now. So stick with me until the end, because these strategies could be what you need to transform your financial reality once and for all. The biggest mistake people make when investing? Lack of strategy. They start without a plan, buy random assets, follow tips from social media, and end up quitting when they don't see results. And the worst part? Many believe they can only invest if they have a lot of money. But that's not true. The secret is knowing which investments make sense for your current financial situation. Now that you understand the problem, let's get to the solution: how to invest at every wealth level. If you have up to $5,000 to invest, your priority shouldn't be chasing the highest returns possible. It should be building a solid financial base. The most common mistake beginners make is skipping this step and exposing themselves to unnecessary risks before even having financial security. Your first step should be to create an emergency fund equal to 3 to 6 months of your basic expenses. This emergency fund should be placed in a highly liquid, low-risk investment, like a high-yield savings account or a fixed-income fund. Once this safety net is in place, you can start investing intelligently, focusing on secure, accessible assets like fixed-income ETFs, which provide stability and protection against inflation. Another key point is getting into the habit of investing regularly, automating small monthly contributions. This not only ensures consistency but also reduces the impact of market fluctuations, allowing your money to grow predictably and sustainably. Many beginners make the mistake of chasing quick returns in volatile investments, such as cryptocurrencies or speculative stocks, before securing a solid foundation. This can lead to significant losses and early discouragement. The secret at this stage is prioritizing security and discipline, building a sustainable investment habit. An effective strategy is to set up an automatic contribution plan, where a portion of your income is invested before you spend it, creating a pay-yourself-first effect. This way, even with little money, you begin positioning yourself as a long-term investor. And remember, it doesn't matter how much you have today. What really makes a difference is consistency over time. Small, well-structured investments today can turn into a great fortune in the future. Now that you've crossed the $5,000 mark, it's time to consolidate your first investments and structure a more balanced portfolio. At this level, the focus should be on broadening your diversification without taking excessive risks. The first step is to expand your exposure to the stock market safely, using equity ETFs, which offer automatic diversification and less volatility than individual stocks. Additionally, REITs, real estate investment trusts, are an excellent option for starting to invest in real estate without the need to buy physical properties, providing an additional source of passive income. Here, the strategy should be based on sustainable growth, regular contributions, reinvestment of dividends, and strategic portfolio adjustments as your risk tolerance and financial goals evolve. The most common mistake at this level is rushing to accelerate wealth growth, causing many investors to take unnecessary risks in highly speculative assets. Instead, the key is to maintain consistency and continue contributing to solid, diversified assets. Besides traditional investments, consider including medium-term fixed income to balance your portfolio and protect your capital from sharp market fluctuations. Another crucial point is starting to understand the importance of a long-term mindset, resisting the temptation to realize quick profits and focusing on gradual wealth building. After all, financial success doesn't come from big, sudden gains, but from discipline and patience, allowing your money to work for you over time. With more than $50,000 invested, you've passed the initial stage, and now you should focus on strategic wealth building. At this level, diversification becomes even more important because your portfolio is already solid, and now it needs a balance between growth and security. The first step is to begin investing in individual stocks of solid companies, prioritizing sectors that have historically demonstrated sustainable growth, such as technology, healthcare, and consumer essentials. Additionally, expanding your investments into international markets can protect your portfolio from local crises and increase return opportunities. This is the time to start exploring alternative assets, such as REITs, real estate funds, and even commodities, ensuring that your portfolio has different sources of appreciation and protection against market fluctuations. Many investors at this level fall into the trap of becoming too comfortable and neglecting to review and optimize their portfolio regularly. However, as your wealth grows, your strategy should evolve too. Now is the time to monitor your portfolio more closely, making adjustments as needed to maintain a balance between risk and return. An essential step is reinvesting dividends and compound interest intelligently, leveraging the multiplier effect over time. Another valuable strategy is to diversify your passive income, including investments that generate cash flow, like dividends and rents, so that part of your earnings can already be converted into financial freedom. Building wealth isn't just about accumulating money, but creating a sustainable, resilient financial structure capable of growing regardless of market fluctuations. Reaching the $250,000 to $1 million range means you're entering a level where your strategy needs to be more sophisticated, focused on accelerated expansion and tax optimization. At this stage, the focus should be on maximizing returns while protecting your capital from excessive risks. An excellent option is investing in private equity and startups, which, while risky, have the potential to generate exponential returns. These assets can significantly leverage your portfolio if chosen correctly. Additionally, investing in physical real estate is a powerful strategy to generate passive income and create continuous cash flow. Adding real estate to your portfolio not only diversifies it, but also brings stability, as properties tend to appreciate over time and provide a reliable source of monthly income. However, at this level, wealth protection should be a priority. Ignoring aspects like tax planning and adequate insurance can compromise part of your financial growth. An intelligent strategy is to consult with specialists to plan your tax strategy, aiming to reduce your tax burden legally, and ensuring asset protection through insurance that covers not only your physical assets but also intangible ones. Furthermore, risk management becomes even more important as the invested value grows, meaning your portfolio must be regularly optimized. The key to success at this stage is intelligent diversification, combining different types of assets, from stocks and real estate to businesses, to create a financial structure that continues to grow while withstanding market fluctuations. Reaching the $1 million mark is a significant milestone, but it's also when your investment approach needs to shift to ensure sustainable wealth preservation and growth. At this level, the focus should be on generating consistent passive income and preserving your capital. Dividend investments, such as stocks of established companies that pay good returns, are essential to ensure a continuous cash flow. Additionally, long-term fixed income, such as government bonds or fixed-income investment funds, should be part of your strategy to balance risks and bring stability to your portfolio. The goal now is to generate enough passive income to cover your expenses, allowing you to achieve true financial independence, where your money works for you without relying on a paycheck. One of the biggest traps at this level is continuing to take high risks unnecessarily, which can jeopardize the wealth you've built over the years. The priority now should be preserving your wealth and ensuring it is transferred to future generations efficiently. This means estate planning becomes essential. It's time to think about how to preserve and transfer your wealth to your heirs in a way that minimizes taxes and legal costs. Consulting with attorneys specialized in estate planning is a crucial step to ensuring your legacy is well managed. Furthermore, adjusting your risk strategy to focus on more stable and secure assets, while continuing to seek moderate growth opportunities, is the necessary balance to maintain your financial position in the long run. True financial freedom comes when you can live off the returns of your investments, no longer relying on active work. Now you know exactly how to invest at every stage of your financial journey. The most important thing isn't having a lot of money to start, it's starting with the right strategy. Comment below what stage you're at and what your biggest question about investing is. If this video helped you, leave a like and subscribe to the channel for more content on investing and financial freedom. See you in the next video.